In trading, an edge represents a quantifiable advantage. This advantage results in more profitable trades than losses over a significant number of transactions. The edge remains profitable even after all associated expenses are considered. This ensures the trading system has a positive expected value plus EV. A lack of a statistical edge in trading is akin to gambling. Trading costs, such as commissions, can erode capital over time. Slippage, the difference between expected and actual execution price, further diminishes returns. Bid-ask spreads, the difference between buying and selling prices, also contribute to capital erosion. These costs, combined with the absence of a statistical advantage, lead to losses. Consistently profitable trading requires a demonstrable statistical edge to overcome these costs. Trading without a defined strategy removes any potential advantage. Relying on gut feelings, or FOMO, leads to unpredictable results. A trading strategy provides a structured approach to decision-making. Without a strategy, trading becomes akin to gambling. A defined strategy incorporates risk management and profit targets. Consistent application of a strategy allows for performance, evaluation, and refinement. Relying on widely available news for trading decisions is often ineffective. Common technical patterns are also unlikely to provide a trading advantage. This is because such information is rapidly incorporated into market prices. Consequently, acting on these signals rarely yields profitable opportunities. Transaction costs can significantly impact the profitability of a trading strategy. These costs include commissions charged by brokers for executing trades, spreads, the difference between the buying and selling price of an asset also contribute to transaction costs. Slippage, the difference between the expected price of a trade and the actual execution price, is another factor. In high-frequency trading, these costs can quickly accumulate and negate potential profits. Careful consideration and management of transaction costs are crucial for strategy success. Over-optimizing a trading strategy involves excessively tailoring it to past data. This process aims to achieve the best possible performance on historical datasets. However, live markets are dynamic and constantly evolving, differing from static historical data. Strategies excessively fitted to the past may fail to adapt to new unseen market conditions. Inadequate risk management can undermine trading success. Risky strategies include allocating a high percentage of capital per trade. Even with a statistical edge, such practices can lead to substantial losses. Effective risk management is crucial for capital preservation and consistent profitability. Emotional trading negates any statistical advantage a trader might possess. Decisions driven by emotion deviate from a well-defined trading plan. Allowing losses to escalate unchecked is a common manifestation of emotional trading. Prematurely closing profitable trades is another example of emotionally driven decisions. Retail traders face challenges when competing with institutional traders. Institutional traders often have access to superior technology. These advanced tools provide a competitive edge in the market. Institutional traders typically benefit from lower transaction costs. They also possess more comprehensive market information. These advantages are particularly pronounced in liquid markets. Identifying market inefficiencies is crucial for gaining a competitive edge. Market inefficiencies include price discrepancies between related assets. Behavioral biases also contribute to market inefficiencies. Analyzing these inefficiencies allows for strategic advantage. Retail traders can explore less efficient markets to identify profitable opportunities. Small-cap stocks represent one such market due to limited institutional involvement. The reduced presence of large institutions leads to market inefficiencies. These inefficiencies can be exploited by retail traders with appropriate strategies. Focusing on small-cap stocks allows retail traders to find potentially lucrative opportunities. Rigorous backtesting is essential for validating a trading strategy. Backtesting simulates the strategy's performance on historical data. Forward testing further validates the strategy in a live or simulated environment. Forward testing assesses the strategy's real-time performance. Both backtesting and forward testing ensure the strategy performs as expected. These tests evaluate the strategy's robustness under different market conditions. A trading strategy requires a well-defined logical premise. This premise should justify the strategy's potential for generating profit. An example premise is that momentum often continues after a high-volume breakout. The premise must be testable and quantifiable. The strategy's edge is derived from the statistical validity of the initial premise. Analyzing key metrics is crucial for assessing a strategy's viability. Important metrics include win rate and risk-reward ratio. Expectancy and maximum drawdown are also key indicators. Sharpe and Sortino ratios provide further insights into performance. Specializing involves focusing on a specific area or setup. This focused approach allows for a deeper, more nuanced understanding. For example, one might specialize in opening range breakouts. Specialization enables the identification of subtle details often missed by others. This expertise can lead to a competitive advantage in the chosen area. Slippage can negatively impact trade execution and profitability. Trading during liquid market hours helps reduce slippage. Utilizing limit orders is effective in controlling execution prices. Understanding market microstructure enhances trade execution strategies. Selecting brokers with favorable terms is crucial for profitable trading. Low commissions directly reduce the cost of each trade. Tight spreads minimize the difference between buying and selling prices. These factors are especially important for high-frequency trading strategies. Effective risk management is crucial in trading and investment activities. A key strategy involves limiting the capital risked on any single trade. Consistently risking only 1 to 2% of total capital per trade is a prudent approach. This approach prevents substantial losses from single adverse events. Using stop-loss orders is also vital for managing downside risk. Stop losses automatically close a position when it reaches a predefined loss level. A strategy's worst-case drawdown must align with an individual's psychological tolerance. This alignment is crucial for maintaining rational decision-making during periods of loss. Psychological tolerance refers to the level of financial loss an individual can withstand emotionally. When drawdowns exceed this tolerance, emotional responses can lead to poor choices. Emotional decision-making often results in abandoning a sound strategy prematurely. Therefore, understanding and respecting psychological limits is key to long-term strategic success. A trading journal is a detailed record of trading activities. It includes rationale behind trades, emotional state during trading, and trade outcomes. Maintaining a trading journal helps in reviewing trading decisions. It also helps in validating the trading edge over a period of time. An equity curve visually represents the performance of a trading strategy over time. A consistently downward-sloping equity curve suggests persistent losses. This pattern, observed over many trades, indicates a potential lack of edge in the strategy. Such a scenario necessitates a thorough re-evaluation and potential revision of the trading strategy. A trading edge is the distinct advantage a strategy has over others. Clearly articulating this edge is crucial for understanding the strategy. The inability to describe the edge concisely indicates a lack of understanding. This lack of understanding undermines the strategy's potential effectiveness. A well-defined edge allows for consistent and informed decision-making. Therefore, a clear articulation of the trading edge is paramount. A trading strategy may show promise in backtests, but fail in live trading environments. This discrepancy often indicates that the strategy is overfitted to historical data. Overfitting means the strategy is too specific to the past and doesn't generalize well. Another reason for failure is neglecting real-world trading costs during backtesting. Slippage in commissions can significantly impact profitability in live trading. Constantly changing strategies after minimal losses is a common pitfall. This behavior often indicates a lack of strategic discipline and patience. It suggests a search for an elusive, perfect strategy that guarantees success. Such a holy grail strategy is often unrealistic and unattainable. Effective strategy implementation requires consistent application and refinement. Prematurely abandoning a strategy prevents proper evaluation and improvement. Passive investing is a strategy that involves investing in low-cost index funds or ETFs. It is suitable for investors who find it challenging to identify a competitive advantage in the market. Passive investing offers a mathematically sound, default investment approach. This strategy aims to match the returns of a specific market index rather than outperform it.